In this free video course, you will learn everything you need to know about Bollinger Bands for trading crypto, forex, stocks, or any other financial market. By the end of this course, you will not only be able to use Bollinger Bands like a pro, but you will also learn multiple Bollinger Band settings that most traders don't know about. Alright, so hello guys and welcome to this Bollinger Bands training course. And let's begin here by taking a look at what you can expect to learn in today's video. And the sort of very first thing we of course need to talk about is what are Bollinger Bands? Because if we want to use Bollinger Bands effectively, we of course need to know, what are they in the first place and what do they even measure? And we also of course need to know why would we even use this indicator. So chapter 1 is very important and a solid start of the course. Next, I want to move on to how Bollinger Bands work. So this chapter is where we dive a little bit more into detail on how the Bollinger Bands work, because as with pretty much any indicator, I really recommend, if you want to use an indicator, you need to at least understand the basics of how they work. So chapter 2 right here is a very important follow-up to chapter 1. Next, we're ready to move on to something super critical here, and that is a common mistake, a common Bollinger Band mistake I see many traders, especially beginner traders, make. So we're going to take a look at that mistake, or maybe even two mistakes, and how you can easily avoid them. If you can avoid these mistakes, you will be able to use Bollinger Bands much more effectively. So now, after chapter 3, we have a solid understanding of how Bollinger Bands work with no mistakes to avoid. So now we are finally ready to start taking a look at some practical and some of the best for beginners Bollinger Band trading strategies, and I will break down these strategies in a simple step-by-step manner. So even if you are completely new to Bollinger Bands, if you have been watching chapter 1, 2 and 3, you will be able to understand chapter 4 and get the most out of chapter 4. But I have built this course in a step-by-step manner, so before you watch chapter 2, it is important, or at least highly recommended, that you go through chapter 1, 2 and 3. Last but definitely not least, if you want to dive even deeper and master Bollinger Bands, I will show you guys some advanced Bollinger Bands settings that can really improve your trading. Maybe you are focusing on day trading, maybe you are a swing trader. I will show you guys how you can change the settings to get the sort of best settings for your market. So yeah guys, I hope this sounds good, and without further ado, let's dive in here to chapter 1. Alright, so now then, what are Bollinger Bands? Well, let's begin here by taking a look at a simple definition. Well, in simple terms, Bollinger Bands are a trading indicator that measures something called price volatility. And price volatility can help us traders identify potential market movements. And this is basically our goal as traders. We want to be able to identify market movements to make money off these movements. So if you guys just quickly take a look at this image right here. Here on the screen, we can see a Bollinger Band. The Bollinger Band is this, or we actually have two Bollinger Bands. We have an upper Bollinger Band, which is the red line. We have a lower Bollinger Band, which is the green line. And we also have a middle band right here. And don't worry, I will go over exactly everything you need to know about the technical stuff about the Bollinger Band. But for now, the only thing you need to learn is that the band gets smaller and smaller when we have small price movements, like for example right here. So when we have small price movements, the band contract, but you can see when the price start to move a lot, like for example right here. By the way, this right here is what we call a Bollinger Band breakout, and this can lead to big movements towards the upside, and we will talk more about that later on in this course. For now, All you need to notice is that when the price starts to move a lot, like right here, you can see that the bands will expand and get wider and wider. And this is basically the price volatility. When the bands are small, we have low volatility. When the bands are large, we have high volatility. And now let's of course take a look at why traders use it. What is the purpose of Bollinger Bands? Well, traders use Bollinger Bands to detect many different things. One such thing is trend reversals, and I will talk in detail later on in this course how we can find trend reversals, when the price will either reverse to the upside or the downside later on in this video. But we can also use Bollinger Bands to find continuation patterns. A continuation pattern is basically when we have an uptrend and we get some sort of signal, maybe a signal right here, that the uptrend will continue. And this of course works for the downside as well. Bollinger Bands can also suggest consolidation phases, and this is basically sideways movements. And your ability to be able to detect sideways movement is actually a very important skill as a trader. So Bollinger Bands have a very versatile use case. And what is the general idea here about the bands? Well, I have already mentioned this briefly, but let's repeat here. The bands will expand, or in other words, be wider and wider when the market becomes more volatile, and the bands will contract, or in other words, get tighter and tighter when the market becomes less volatile. And this is the very simple general idea behind the Bollinger Bands. But alright, so now I want to dive a little bit deeper into Bollinger Bands and volatility. Being able to understand volatility is very key if you want to use Bollinger Bands effectively, so this slide is important, but I will keep it as simple as possible. So first of all, we need to understand what volatility measures. And in simple terms, volatility measures how much the price of an asset moves over time. So how much is the price moving? And this can be very hard to understand without seeing an image, so I will show you guys an image very soon. But in simple terms, high volatility means that the prices move quickly and often unpredictably, creating large swings both to the upside and the downside. And the reason we say unpredictably here is that volatility is often a measurement of risk. So sometimes in the finance world and in the trading world, people will actually use volatility and risk in very similar manner, but they are not really the same concept. That is important to notice. Low volatility is of course the opposite of high volatility, and this is where prices are more stable and moves slowly over time. So to understand this, let's take two examples. So let's begin with low volatility, and let me have a special color for this. So a low volatility market might look something like this. To keep it simple, let's just say the market moves sideways. So as you can see, here the market moves sideways, but the swings up and down are pretty small. So this right here is what I would say is low volatility. However, if we compare it with high volatility, so high volatility would look more something like this. Here you can see that the average price is the same, right? The average price is the same, but the swings are much wider. So if we, for example, plot a moving average on this chart, you can see that the average price, this blue line right here, is a moving average. The average price for both of these prices, both the red and green, is exactly the same. However, the volatility between these two are different. And this is a very important concept to have in mind throughout the rest of the course. But alright, so if you want to use Bollinger Bands, you of course need to know how Bollinger Bands work. So now I will tell you guys all the things you need to know about Bollinger Bands before you can start using them. And I will try to do this at least in a simple as possible manner. So first of all, what we need to know is that the Bollinger Band consists of three main parts. The first part is called the middle band, And the middle band is very simple. It's a simple moving average, or in other words, SMA. If in some cases we can actually change the setting, so in some cases we might have an EMA or even another type of moving average, and I will talk about that later on in this course. But for now, what you need to know is that the middle band is a moving average, and most of the times it's a simple moving average, and the period is often 20. So the sort of standard settings is often 20. So in other words, we often have an SMA 20 as the middle band. And by the way, guys, if you want to dive even deeper into moving averages, I actually have a full moving average trading course here on the channel. So I will make sure to have it linked up in the corner in the eye, so you can watch that course after this course if you want to become even better. But okay, so we know that the middle band is a moving average. But now then, what about the upper band? Well, the upper band is a line plotted 2 standard deviations above the middle band. And standard deviations is a pretty technical term, and we will talk about it very soon. But for now, what you can see here is that the upper band, which is the red line right here, is always plotted above the middle band. And the length here between the middle and the blue line is determined by something called standard deviations. And as I said, I will talk about that very soon. But first, what is the lower band? Well, the lower band is the exact same as the upper band, but the opposite. So this right here is a line plotted 2 standard deviations below the middle band. So what we can derive from this is that the length here from the middle to the top and from the middle to the bottom, so this black arrow and red arrow always have the same length. So it doesn't matter where we look at on the chart. So if you look right here, we can see that this length is equal to this length. If we look right here, this length should be equal to this length, and so on and so on. The upper and lower band will always be, the same distance away from the middle. But now then, what is a standard deviation? And here I actually thought a while about, how is the best and shortest way to describe standard deviation. And I would say that this is a measure of how much prices vary from the average. Remember here, the middle band, this is a blue band, so let me actually use another color like this. The middle band here is the average. We know that from the text earlier here. And the standard deviation measures how much the prices tend to move away from the average, or how much the prices tend to move away from the middle band. So when we have been having a period here where the price haven't moved a lot, like for example right here, we can see that the prices right here have been going sideways with not a lot of movements. We can see that the band here is getting pretty tight. But then when we see strong movements and the price start to move more, we can notice that the bands expand. So think about standard deviation as how much the price tends to vary from the average price. Alright, so before we continue here, I want to give a big shout out to all our new channel members. You guys are making these videos possible. I spend a lot of time and effort on these videos, so if you want to give back while at the same time getting access to exclusive content, please consider becoming a channel member by clicking join below this video or on the channel page. Now let's jump back into the course. But alright, so now the time has come to take a look at one of the worst Bollinger Band mistakes that you really need to avoid. And you might of course wonder, what is this mistake? Well, one thing that I see so many beginners do is to regard the Bollinger Bands as support and resistance. So for example, they might say that the lower Bollinger Band will be a support level, and therefore it's logical that the upper band will be a resistance, right? And then the reasoning goes like this. When the price hits the lower band, that's a buy signal, and when the price hits the upper band, that's a sell signal. But this right here is often a recipe for disaster. Because as we can see in this example, you can see the price right here, we hit the lower band, and we actually saw a bounce. So if you are a beginner trader, you might think about this like, okay, so it looks like the lower band is a sort of support level. So shouldn't that mean that when the price hits the lower band, that should be a buy signal? Then the price start to go down here, and maybe you see a little beginning of a bounce here, so you might actually buy on this candle. But you can see that the price continues to grind lower. Then we see a little green candle, and that might give you even more optimism that this has to be the point where the price reverses, right? So you might buy even more. But as you can see, the prices continues to grind lower, and eventually this can lead to very big losses. And this is a very important concept to have in mind, that when we see trends, the price will very often pretty much go at the Bollinger Bands. So you can see here we have a massive move, and during this whole move the price was always at the Bollinger Band, and this is a very common thing. And that is why, using the Bollinger Bands as clean support and resistance levels is a very big mistake. Later on in this video, we're going to take a look at a strategy where we can actually combine Bollinger Bands with regular support and resistance to actually build a strategy. But for now, this is a mistake you need to know. And another mistake that is related to this is that many traders that sees this as support will also see the middle band as resistance as well. And using this as a clean resistance is often a bad idea. You can see in this case, it looks like it worked as a sell signal. This was a beautiful sell signal. But this might just be a coincidence, because as you can see, once the price reversed right here, the price touched this middle band, but just completely pushed through. And right here, we actually even broke above the upper band. And this is actually at least in my opinion, much more interesting signal compared to when the price grinds and slowly moves pretty much on a line. And that is yet another thing we will talk about very soon. Alright, so now then, the time has finally come to take a look at a Bollinger Band trading strategy. And the first trading strategy I want to take a look at is called the free bar trading strategy. This trading strategy I don't really hear about a lot, but it can be a really powerful tool, especially if you follow some specific rules. So now I'm gonna show you guys this trading strategy in a step-by-step manner. But of course, first of all, we need to know what is a free bar. You might have never heard about this concept. Well, the concept is very simple. A free bar occurs when a candlestick is completely outside the Bollinger Bands. So what do we mean by completely outside? Well, if you take a look at this image right here, what we can see here is that we have some sort of uptrend, we have a swing move, pull back, another swing move, and we also have a Bollinger Band on the chart. However, we do have one candle on this chart that is different than all the rest of the candles, and that is this sort of green candle right here. The special thing about this candle is that the whole candle, so even the wicks, we can see the lower wick is the very low of the candle, the upper wick is the very high of the candle, and we can see that nothing of this candle is inside the channel. Nothing is even touching the channel. This is a candlestick completely outside of the Bollinger Band, and this is what I mean by free bar. But now you might of course wonder, so does this mean that every free bar will be a reversal? For example, in this case, you can see that after the free bar occurred, we saw a massive move to the downside. So this was a very good sell signal, or a signal to short. Short selling is basically when you bet against the market, so you can make money from the price going down. But well, what does a free bar actually tell us? Well, the first thing we can notice is that the free bar signals unusually high volatility. And this right here is not a certain sign of a reversal, but it's a sign, it's a definitely an indication and an early sign of a potential reversal. So when I see a free bar, I'm not just gonna enter every single free bar, even though they are a bit rare. It depends on the settings. We'll talk about the settings later on in this video, but for now just notice that in order for the free bar trading strategy to be effective, we definitely preferably want to combine it with other things. So as you can see right here, it's highly recommended to combine free bars with price action, but also market structure principles. And if you wonder what is price action and what is market structure, well, that is a very deep topic. But luckily, I do have a full price action trading course that you can watch right here. And I also have a full market structure trading course that you can watch. And I definitely highly recommend that you go through both of these courses step by step, because these courses will not only help you with the free bar trading strategy, but they can pretty much improve most other trading strategies as well. So if you have the time, make sure to save these videos for another time and make sure to really watch them from beginning to end. But using this free bar trading strategy, especially together with price action and market structure, can be a very strong tool. Alright, so now it's time to take a look at yet another Bollinger Bands trading strategy. And this one is called the Bollinger Band Squeeze strategy. And what is this strategy? Well, the principle here is that when Bollinger Bands contract, or another word for this is squeeze, it signals low volatility, but also a potential for a breakout. So as you guys can see on this image right here, we can first of all see that in the beginning we have a very sort of wide band, and this indicates high volatility. But as the price goes on, we can see that the bands are contracting and contracting. And this right here is a first sign that you can look out for a breakout. But now then, how do we actually trade this thing when the bands are squeezing tight? Well, the first thing, and this is very important, is that we want to wait for the price to decisively break either above or below the bands. And what do I mean by decisively break? Well, what I'm looking out for here is that we're looking out for a strong candle close above the band. So let's once again switch the attention here to the image. And the first thing I want you guys to notice is that first of all the candlesticks here are inside of the bands until a certain point. You can see here that for a very short while on this green candle right here, the candlestick slightly pushed above the band. So some traders might say, isn't this a breakout above the band? Well, here is where the strong candle close comes in. What I'm looking out for is that I'm not only looking out for a candle closing above the band, I want the candle to close above the band with some additional distance. So it's actually not until this candle right here where we see a strong candle close. You can see this candle closes very high above the band. So this right here is a breakout. However, this strategy is not done here, because in order to sort of use this strategy, you need to know about a few important tips. And the first tip here is to use support and resistance levels to validate the breakout. So these breakouts from Bollinger Bands happen pretty often, and many times they can actually give false signals. Remember here, the free bar strategy we talked about earlier, is actually a form of breakout where a price, if this right here is the Bollinger Band, and we get a candle completely outside, this is a form of breakout, right? But this is a form of extreme breakout that can actually indicate a reversal. So it's very important that there are nuances to this. So one thing that can definitely improve the sort of breakout or Bollinger Band Squeeze strategy is if the breakout occurs at the same time where we have a resistance. So here you can see we had resistance not only one time, 2 times, 3 times, and then we saw a massive breakout. Not only did we break resistance, but we also broke a Bollinger Band. And if we want to dive even deeper, perform even deeper analysis here, what do we notice? We have an ascending triangle. This is also a continuation pattern indicating a continuation to the upside. So here we not only have 1, 2, but 3 bullish signals happening at the same time. So this right here was a very good example. You know, many times when you trade, it can actually take a lot of time to find these great setups. But here we had a bullish chart pattern, which is an ascending triangle. By the way, if you want to learn more about chart patterns, I will make sure to link my full course on that. But we also had a break of resistance, break of Bollinger Bands. So we had 3 great signs. Another sign you can actually look out for is that you can look out for volume. So if we have high volume when we see a breakout, that is another great sign. Alright guys, so now the time has finally come to take a look at some of the best Bollinger Band settings you need to know about. And when it comes to Bollinger Bands and also many other trading indicators, it's usually a good idea to change the setting according to the market you're trading and the time frame. But the settings we're going to talk about here is first a setting called the 10-1.5 setting. And this is a setting I recommend mostly for day traders or even if you are scalping. So this setting, compared to the standard setting of the Bollinger Band, is for much shorter term movements. So if you are, day trading or scalping, this might be the setting for you. But I can also mention that even if you are only a day trader, it's not really enough to only learn about this setting. In order to maximize your knowledge about Bollinger Bands, I actually recommend that you learn about all 3 settings we will talk about in today's video. But now then, the next setting we're going to talk about is called the 52.5. And this one is more suitable for swing trading. And when I talk about swing trading, I talk about maybe trading 1 hour candles all the way up to daily candles. One could actually argue that you can also use Bollinger Bands if you are more of an investor. So maybe you trade, weekly candles. Then a setting similar to this might be the best choice. Last but definitely not least here, we are going to take a look at something called Keltner channels. And yes, guys, I do have this on our sort of settings chapter, but this right here is actually a whole new indicator, but it works in a very similar manner to the Bollinger Band, and you can actually, the strategies we talked about earlier in the course, you can actually use for Keltner channels as well. So I will include this as a last sort of chapter of the video, but this is not really a setting, this is actually a whole new indicator. But alright guys, so now let's jump into TradingView. TradingView is the software I use for all things trading. I do all my analysis in here, I find all the markets in here, and you can actually also connect many brokers to TradingView if you want to trade inside of TradingView. But if you guys for some reason haven't gotten started with TradingView yet, this is actually the best time of the year to get started with TradingView. You might wonder why. Well, once a year, TradingView has a Black Friday sale. And as I'm recording this video, the Black Friday starts in just a few days. So when I release this video, it might be, just in time for Black Friday. So if you for some reason haven't gotten started with TradingView yet, make sure to check out the link. It will be both in the top of the description and it will also be in the top pinned comment. By using the link, you can get 70% off TradingView plans. You can also get 1 month free and you can get $15 bonus. But alright, so now let's take a look at our first setting. And the very first thing we need to do here is of course to open up the Bollinger Band indicator. And to do this, what we need to do, we simply go up here to the indicators tab in TradingView, and then you want to simply search for Bollinger Bands. And as you guys can see, when it comes to TradingView, we have tons of different indicators here created by the TradingView community. And here I actually have many Bollinger Band indicators that I am interested in, but for this video we're gonna keep it simple and we are gonna use the one simply called Bollinger Bands. So make sure to open this one up. And now to change the settings of the Bollinger Band, what you need to do is that you simply need to go up here to the upper left corner and you want to press on the settings cogwheel right here. And as you can see here, we have a window appearing and we have a few different settings. The first setting is called length. This setting right here determines the length of the moving average. And remember from earlier in the course, the standard length of the moving average is 20. The next setting right here, it says basis moving average type. On this setting, you can actually change the moving average. So for example, the standard setting is simple moving average, but if we want to use an exponential moving average, we can simply use the EMA. This will actually be a pretty significant change to the Bollinger Band. We also have the SMMA, we have the WMA, the weighted moving average, and so on and so on. But the first setting we're going to use, we're actually going to keep it at SMA here. But one important change, or let me actually go over the setting first here. So the source is very interesting. The standard, you can see it says close right here. That means that the Bollinger Band make its calculations based on candle closes. One setting you can use here is the OHLC4. This one will change the calculations so the Bollinger Band take the open, high, low and close in consideration when calculating. But for our first setting, we are actually going to keep it at close. Now, this setting is very important. This is the standard deviation we talked about earlier in the course. And the standard deviation here is 2. But for this setting, we're actually going to decrease this one to 1.5. This will change the indicator and shrink the Bollinger Bands. So now instead of the Bollinger Bands being 2 standard deviations away from the middle, now they will only be 1.5. So the Bollinger Band will be tighter in general. And what we're also going to do is that we're going to change the length here of the simple moving average to 10. This will make the Bollinger Band much more short term. So make sure to have 10 and 1.5 right here. And if you want to, what I like to do here is that I like to go here to the style tab and I like to just increase the thickness a bit of the basis here. This is also so you guys can see the indicator more clearly. And I also like to just make the upper band black and the lower band black and a bit thicker as well. I feel like this makes the indicator so much more clearer. But now our first setting is done, so we are ready to go down here and press OK. And now, as you can see, the Bollinger Band has become much tighter. And this is one of the reasons that I said that this one is more suitable for short-term traders. If you are day trading or if you are even scalping, you might only, care about a few candles, and this shorter moving average period will make the indicator and the Bollinger Bands more reactive, and this can be suited for you. But now then, you might wonder, how do we even use this setting? Well, they are, as I said, strong in different scenarios. So let's take a look at this chart right here. Right now, we're looking at a 15-minute Euro-US dollar chart. And one very interesting thing we can see right away here is that, one candle was standing out. If we look at this chart, we can see that the tight Bollinger Band will actually make the price sort of quickly move below and above the price multiple times. But there's only one movement that, in my opinion, sticks out a lot, and that is this candle right here. You can see right here, we actually have a free bar. And as we talked about earlier in the course, free bars are a first indication of a reversal. So this right here is a sign that we might have a good reversal trade right here. However, it's not really enough to only find a free bar, especially when you're using these settings. You will notice that you will actually find quite many free bars. So what you need to do here is that you need to combine it with price action and market structure. To learn more about these two, as I already mentioned, you can watch, I have a full course on market structure and price action here on the channel. I highly recommend to watch them. But let's take a look at the market structure. We can see that the price clearly reversed here. We had a strong move down. We reversed. We pushed quickly below. You can see with this candle right here, the price pushed quickly below and then we sharply reversed. This thing right here, when we quickly dip below support and then reverse, is something known as a failure test. And this right here is yet another reversal sign. So now we actually have two reversal signs happening at the same time. We have a free bar and we have a potential failure test. A third signal here, and this is a price action signal, is that this candlestick itself is actually what is known as a dragonfly doji. And this is yet another reversal signal. So after this, we have three reversal signals happening at the same time, and that is enough for us to take the trade. So a trade example could look something like this. We would enter at the candle close of the price action signal, setting the stop loss just below the lowest point of the free bar, and with a 2-to-1 risk to reward ratio, our target would be right here. And as you can see, this is a very short-term trade. We are on the 15-minute time frame, so just like an hour later, we would have locked in some nice profit. But all right then, so now we are ready to take a look at our second setting. And remember, this right here is a more long-term setting. So for this example, I will look at the daily chart. And the market we're using is gold, or for short, XAU USD. And now, once again, we go up to the indicators tab to just open up the Bollinger Bands right away. Oh, I misspelled Bollinger Bands. So you want to open this one up right here. And to go to the settings tab, once again, we head up to the upper left corner and we press on settings. Now, because this is a more long-term setting, the first setting we want to change is the length here. And we actually want to change this one all the way up to 50. And if you are a little bit familiar with moving averages, you might be familiar with the 50 period simple moving average. And this is what we're going to use for this setting. We will have a length of 50 and we will use a simple moving average. However, what we also want to do here is that we want to change the standard deviation down here. Because this is a long-term setting and we are focusing on larger movements, we actually want to change the standard deviation to 2.5. And remember, what does this do for the Bollinger Band? Well, this will make the Bollinger Bands expand a little bit more. So make sure to have 2.5 right here, and that's it. You can, of course, also change the moving average, but I recommend it to keep it simple moving average here. The source you can also keep on close. So now, guys, we're ready to go down here and press OK. But now then, how do we actually use, these settings of the Bollinger Band? Well, remember, just recently I showed you guys how you can use the free bar strategy, but another strategy we talked about earlier in the course was the Bollinger Band Squeeze strategy, or the Bollinger Band breakout strategy. And this is when we are looking out for the band contracting and getting tighter and tighter. After this tightness, what we want to see is that we want to see a strong break above the band. And as you can see with this candle right here, we got the strong break above the band we're looking out for. But when it comes to this strategy, it's very important to not, only look at breaks of Bollinger Bands. To make this one stronger, we want to, of course, combine it with market structure and price action. And on this particular example, we can actually see that we have some very important market structure right here. First of all, we can actually see that we are in a sort of trading range. We can show this trading range by drawing two horizontal lines, and as you can see, the price was consolidating here between a support level and a resistance. And with this candle right here, we actually break two things. We break above the Bollinger Band and we break the resistance. But now, if you have been paying really close attention to the course, you might notice that the next candle right here, isn't this what we call a free bar. Well, that is true. This is a free bar, and remember, a free bar indicates a potential reversal to the downside. And you can actually see that in this example, we had multiple free bars. And you might wonder, why is this the case? Why does the price continue when we see a free bar? Well, this is when market structure and price action comes in. It's very important to analyze both how did the market look like before we saw this breakout. Well, here we know that we had a trading range before the breakout, so the breakout actually suggests continuation to the upside, and the actual free bars right here can just be an indication of a very strong trend. The other thing we need to notice here is that it also depends on how the free bars look like. So remember from the earlier example, it looks a bit ugly right here, but remember that the free bar here was a candlestick that looks like this. This right here is a bullish candle itself, so this is another signal of a reversal. But if we go back here to the other chart, we can see that in this case, all of the free bars here were bullish candles, and this is a signal that goes in this case as continuation compared to reversal. So it's very important to not blindly, as I have been mentioned again and again in this video, it's not important to just blindly follow free bars or just blindly follow Bollinger Band squeezes. It's important to have the full context, and to have that, you need to learn about market structure and price action. Alright guys, so now last but definitely not least, it's time to take a look at the Keltner channels. And this right here is an indicator that is very similar to Bollinger Bands, but they are a bit different, and we can't really say that Keltner channels is just different settings. It's actually a whole new indicator. So to open up the indicator, we want to head up here to the indicators tab in TradingView, and you want to search for Keltner, just like this, and then channels. And once again, you will find tons of community built indicators. Some of these are very interesting, but we are going to keep it simple and open up the Keltner channel right here. And the first thing you can notice is that this indicator looks very similar to the Bollinger Bands, right? We have an upper band right here, we have a lower band, and we have a moving average. But now you might of course wonder, what is the main difference between Keltner channels and Bollinger Bands? Well, the main difference is how the upper and lower band is calculated. So to understand this, let's actually head up here to the settings tab for the Keltner channel, and let me delete my drawing, because what we can see here, if we go down to where it says bands style right here, you will notice that the bands will actually base its calculations not on standard deviations, but it will instead base the bands off an indicator called average true range, or for short ATR. And what you also can notice here is that the standard length of the middle moving average is 20, but for Keltner channels, what is the standard setting is to use an exponential moving average. So this is what this setting does. If we uncheck this setting, we will use a simple moving average, and if we check this setting, we will use an exponential moving average. And for the Keltner channels, we can also change the multiplier. So for example, increasing the multiplier will make the bands much wider, and if we decrease it to maybe 1, they will be much smaller. But in general, the ATR will make these channels sort of more smooth compared to the standard Bollinger Band. Let's actually open up a standard Bollinger Band here just to make the comparison. So what we can see here is that the Bollinger Band will have more sort of spikes below and spikes above, like we see right here. If we scroll down here, you can see yet another, we have sort of larger spikes, larger volatility spikes, while the Keltner channel will have a more stable process. And if you're wondering what strategies can we use for the Keltner channels, well, you can use the free bar strategy, you can also use the squeeze strategy, and we have other strategies as well. I know many traders will use the Keltner channels for continuation trades when they trade pullbacks, but that's a little bit out of the scope of this video. Alright, so this video is coming to an end very soon, but first I want to thank you all so much for watching. I also want to give a big thank you to all our channel members. You guys make these videos possible. To support the channel, consider becoming a member by clicking join or simply drop a like on the video. And last but not least, when you are ready to continue your trading journey, I highly recommend checking out this playlist. It contains all the educational trading courses I have made so far, and more is coming very soon.